Yeah, no, I think the big takeaway from the quarter was really the fact that inflation has been burning into profitability. Over the past 2, 3 months, we've seen stocks and companies like Walmart outperform the broader market because they've been benefiting from food price inflation. They've been passing that on to the end consumer, and typically that tends to benefit comp growth, and that's led to quite a significant rally year to date. However, I think going into earnings season, the risk was always around how they were managing some of the cost pressures, and clearly they're feeling it more than the market had been expecting. So you mentioned fuel, some of the fuel pressures that they were seeing, some wage inflation, some of the supply chain cost pressures as well, and on a net basis, I think inflation, might not be a positive for earnings growth anymore. And for some of these stocks which had been trading at relatively elevated valuation multiples going into earnings season, in a rising rate environment, if you don't deliver the earnings growth to justify some of the multiples, then you're going to get punished by the market.
If that's the case, why then did Home Depot argue that there'd been no drop in demand and actually they were able to hold prices in spite of perhaps some concerns that it might reduce footfall? It seems a very different story for this business compared to Walmart.
Yeah, it's an interesting discrepancy. I think the key takeaway is that sales trends generally remain healthy. Home Depot mentioned that they are seeing benefits from commodity inflation and no real shift in consumer demand. But again, that stock has derated significantly over the past couple of months in line with the broader market. And, they manage their costs and their operating costs a lot better than Walmart. And that led to the upside surprise. But I think if we just look at what Walmart was saying, particularly on the discretionary side, they are starting to see signs of softness. They are starting to see signs of shifts in consumer behavior towards things like private label. And I think that means that there are risks to discretionary spend generally going into the second half of this year. And that wouldn't be out of sync with what we've seen historically. So if you look back to previously challenging economic times, like post-2008, for example, you do see shifts in consumer behavior as they trade down to preserve purchasing power. And that tends to come at a cost, particularly for some of the discretionary retailers.
It's Karen